This week in economics on the 2nd of January 2017 from WBRN Radio in Boston and on the Bostonred Network. One of the things we want to achieve in 2017 is giving you the data and in a way that you can use it, and also with less pontification, as one journalist said, is Nicholas Kristof. Nonetheless, we have a family of programs here, from the technical program, the open source report, to the political program known as Bostonred, and our international program, BR on the World. And coming soon, something called All About Sports, where we'll go into sport and the sociology and the economics of sports all at the same time. But today we're going to talk about macroeconomics and where we're going in the year 2017 as we open up. And we'll open up with an area that we'll be looking more into in 2017 called robotics. The Tesla Corporation is rolling out a software update to autopilot on its automobiles. And this is something from Bloomberg News on the 31st of December. Tesla Motors began rolling out software updates to customers with newer cars, bringing them to a parity with owners who have what's known as Autopilot 1, setting the stage to ultimately unleash full self-driving cars, or at least the capabilities. HW2 Autopilot software uploaded to 1,000 on the eve will hold to verify no field issues and upload the rest of the fleet next week. That's from their chief technology office, Elon Musk himself, on their Twitter feed. The end of the year update comes as the automotive and technology industry prepares to descend on Las Vegas. They have the Consumer Electronics Show there, and also in Detroit for the North American International Auto Show, which I think used to be called just the Auto Show. And nonetheless, Tesla is skipping the two productions and is holding is hosting investors at its $5 billion Giga factory east of Reno, Nevada. That will be on the 4th of January. We'll attempt to cover that when Musk will announce in October that all vehicles now being produced by there in Fremont, California, are shipping with new hardware suited to enable full self-driving. He's warned that the cars have would temporarily like some of the we'll call functionality. Autopilot, as the company validates its software, will include some standard safety features like auto emergency braking, collision warning, and active cruise control. Cruise control has been around for a very, very long time. All of Tesla's cars produced since October of 2014 have autopilot software on them, which allows the company to collect more than 1.3 billion miles of data from autopilot equipped vehicles operating under diverse road and, of course, weather conditions. They'll need that in the northeast and various other parts that are getting Arctic air coming into the Midwest from places like Montana. So, in other words, things are continuing to change. Now, while we're on Bloomberg, you just grab a pessimist guide to 2017 here, and various people give their particular takes on things, and we'll try to get to it here. Not exactly what we wanted anyway. Grab one other item here. Here we go, for the emerging markets. We looked at this earlier from Bloomberg, and then we'll go to the market PMI for the Eurozone. Some of the favorites among investors, all things Russian and Indian, are popular, as Brazil corporate bonds and Mexico's cheap peso. This is written on the second here. And the top calls this year are centered on markets where political climate is improving and assets are less vulnerable to external shocks arising from higher U.S. borrowing costs and the election of DJ Trump. The Russian Federation, for investors that borrow in currencies with low interest rates and buy high-yield ones, the Russian ruble is the best bet. That's according to UBS Group AG, where the ruble carries trade could potentially return 26% over 12 months, the most amongst the developed, what they call emerging markets. Aside from having relatively high interest rates, Russia is benefiting from a rise in petrol production. That's something we've been watching, and you should watch also. South Africa, some investments see President Jacob Zuma, power warning boosting the appeal of South African stocks and bonds, especially given that some say the country will probably avoid a downgrade in debt. Mexico, I know the currency is almost attractive amongst is the most attractive, amongst developing so-called Latin American peers. It's not only is the peso cheap, it will benefit from the hawkish Bano-Mexican and the U.S. presidency that is less protectionist than expected. That's from the Chief Risk Officer at Iberia Partners, Mr. Diaz Avera. Brazil. Banco do Brazil Cocoa bonds have an upside to them, according to them. In Chile, the nations and stocks will benefit from rising copper prices. Again, this is commodities. Commodities had been down for a number of years. What goes up comes down. The prospect of more business-friendly policies after 2017 election. All they can bet. That's according to Morgan Stanley and a company. India, given the possibility of a protectionist turn from the U.S. on the DJ Trump this year, South Asian nation assets are looking increasingly attractive. The Prime Minister, I should say, Mr. Modi, November decision to withdraw high denomination bills may see a slowdown and prompt more interest rate cuts, which will be good for bonds. Indonesia. Don't hear much about Indonesia, but many big companies on the benchmark shares index are either domestic-focused consumer firms or mines, which should benefit if coal and nickel prices keep rising into 7. Indonesia's high-yield bonds are perennial investor favorites, especially since the current account deficit has narrowed significantly in the past few years and making the country much less vulnerable to high U.S. borrowing costs. And that's one of the things. Interest rates will more than likely rise at least 3 times in 2017 here in the U.S. We don't know precisely. A lot of that will depend on the spending bills by DJ Trump. Infrastructure bills, that sort of thing will play a role if, and this is a 10-year period, as I understand, $1 trillion infrastructure. And at the same time, you'll have tax decrease on corporations, which they say will spur growth. That the time is out on that. Usually these things do not spur growth. But one of the trends we're seeing now, excuse me, and it's at a very elementary level, that there is some job creation. Example would be Sprint out in the Midwest city, surrounding city of Kansas City. in that Sprint is, of course, owned by the SoftBank Corporation of Japan. But they are promised a $50 billion stimulus, we'll call it, a business-type stimulus into the U.S. economy. Now, this is a number of enterprises that they own. There's one in, I believe, North Carolina that makes low-cost satellites. They'll be hiring roughly 3,000 workers there. And in the Kansas City area with Sprint, they'll be hiring about the same. But these would be customer service and low-level job support. They have made redundant 2,500. So in other words, we're sort of seeing a pattern here that much of this is either 50%, as the case in Indiana with Carrier. In other words, Trump saved 50% of the jobs, 50% went on to Mexico and other destinations. So we're seeing some job creation at the same time. We're also seeing jobs are made redundant, are taken off the table, and newer low-cost jobs coming on the table, which will have some effects. It all would depend in terms of regional economies as to where some of these low-cost jobs are going. Now, when you talk about states like North Carolina, that the cost of living is much cheaper, but although going up, and in South Carolina, these surrounding areas, it's sort of like the automobile plants in Tennessee that have started to organize and get better wages for the workers there. You'll see a lot of worker struggles. The Campaign for 15 is a nationwide campaign in the U.S. and pushed by many cities to at least get to the $10 level and to 15 or 14 by 2020, which is at least 3 years away. And we see a counter move in places like Ohio to take that type of regulatory flexibility from cities and other municipalities. We saw a similar trend that happened. It was disastrous in the internet sector, in that we sponsored campaigns for municipally owned internets, and in Philadelphia was a very large project. And won't get into all the machinations there, but it was contracted out to several different outfits, and I think Wormler's Earthlink or someone like that. But now the city of Philadelphia finally has rolled out their own wireless citywide the last time we checked. In New York, they have citywide wireless there using the old phone boxes. So citywide municipal wireless is definitely the way to go. The internet is, in fact, and should be a utility. Now we're going to see rollbacks. How long these rollbacks will last is anyone's guess, and what effect they will have on the economies. One thing we do know from the data available, that when you have municipal sponsored internet, particularly in smaller communities, you generate more dollars because fiber is available to smaller businesses, and they pay less than they would with a quote-unquote commercial carrier. So those are some of the, in other words, there's a flip side to everything that we see here coming about in these various exchanges. So in other words, in the U.S., you can look forward to these trade-offs, at least in terms of job creation from the small, medium, and enterprise business sector. Now, will other jobs be generated? In other words, there's always a multiplier effect. At this point, we don't know. And the one situation here is the reason we went to Tesla is the thing called robotics. And that is going into plants all over the world. You will see more robotic type programs. Amazon is building these huge data centers, huge distribution centers, and in those are robotics. But they're also creating 500 and 1,000 jobs, some 3,000 jobs, but they're folding many different things in there besides just delivering packages, music, and videos. They're delivering groceries. So that has some effect, disruptive effect, on the food distribution channel. So those are things we look at also, and any analyst should look at the same things and their effect on these economies. And those are things that literally a DJ Trump administration has very, very little control over. Yes, they can jawbone and who used to be Martin Marietta, some of the large tech companies that have these military contracts. It was the F-36, I believe, to decrease some of the costs. But that's in only the planning stage. But at the same time, the increase in the military budget, the increase in the number of ships, that will have effect in those regional locations that have these, Connecticut comes in, somewhat Virginia, have these types of shipbuilding facilities. Now, will that spread across the U.S. as a whole? No. So those are some of the things that we have to look particularly a very close attention to, at the same time starting from the macro level, and the macro level itself has changed over. Let me just get another example here. The pork giant Smithfield, they're out of Virginia. They're skipping what used to be called the middleman, we'll call the middle person in the supply chain. In other words, they are buying their own grain elevators, and thus they can skip the grain handlers. They're owned by a Chinese organization. They bought 2 grain elevators in Ohio in September, so the first time they can ship grain directly from Ohio to feed the pigs in North Carolina. In their packing plants, they are the world's largest processor at 32,000 hogs daily. Smithfield now buys 65% of its animal feed, directly from farmers. That's up from 10% feed they bought directly in 2010, 6 years ago. So in other words, you see more shifting there. Well, who does that affect? Well, the disruption affects people like Archer Daniel Midland Company. Grain can account for up to 60% of Smithfield's costs. So they're dealing with some of this cost. It costs the Smithfield organization $4.67 billion. So they've been canceling quite a few so-called grain handlers contracts. They canceled one in Yuma, Colorado. I've not heard of that place before, but it doesn't matter that much. But as they continue to go directly to farmers and skip even the co-ops, this affects ADM, Cargill, and other one there, the other leading so-called grain handlers that are facing sharp drops in corn and soybeans. So those are some of the things out there that have an effect in commodity prices. The last quarter, ADM and others tended to make up reduced returns on grain trading in the U.S. by selling grain overseas. This is where the global market comes in, making money on storage abundant in U.S. suppliers. In other words, off of the silos. And they have done other things. The Smithfield here buying direct by about 150 million bushels of corn, soybean, wheat, and sorghum per year to feed its 16 million hogs. So evidently they are very deep into pork. And they also, the port there in Wilmington in North Carolina, they import feed from South America and from Europe. So in other words, even the hog, pork, game business is globalized. And this is one of the effects. What effect will the Trump tariff regime have on this type of trading? One will wonder where it goes, and it's very, very difficult to deal with it. So let's go now to, where are we going? We'll go now to China and the Bureau of Statistics there, and we'll briefly go over some of this. We'll append this to our report. Industrial profits increased in the first 11 months, the way they do it. of 2016 profits made by industrial enterprises above the designated side achieved 633.51 billion. So basically almost 700 billion. In the latest 11-month profits of state-holding enterprises above what they call the designated side, there is 10,974.5 billion. So, in other words, 10,000 billion yuan, an increase of 8.2 year over year. That collective ownership enterprises reached 42.6 billion yuan. That's a decrease of 3.7. Enterprise fund from Hong Kong, Taiwan achieved and this is the way they have set this out here, 1,507.6 billion, 105.67 billion yuan, an increase of 10.8%. This would be from Taiwan, Macabo, and others in Hong Kong. Private enterprises gained 16.9 billion yuan. That's an increase of 5.8 billion. The way that they set this out, a little different there. For the first 11 months, the profit of mining and quarrying reached 154.6 billion. That would be 1,100 anyway. They set it out a little bit differently. A decrease of mining, it was down there, of 36.2 billion. Manufacturing was 5,430.68 billion. An increase of 13.7. Distribution of electricity, heat, gas, water reached 447.75 billion yuan. That was down 10.1% for the first 11 months. 41 branches of industrial division. Industrial profits of 30 enterprise industrial divisions increased year over year. That of one remained the same level of 10% decrease. In view of the profit growth, major industries, the percentage of manufacturing textiles up 4.4%. Corking process of nuclear fuel was up 2.2%. That of manufacturing chemical raw materials and chemical products increased to 14.4%. They lay it out in a much more dynamic form than you will see from many statistical bureaus. That of manufacturing of non-metallic metal products increased 11.3%. That of manufacture and process perennial metal increased 2.1%. And manufacturing process of non-terrestrial metals increased 37.4%, and that of manufacturing of motor vehicles increased 12.7%, and that manufacturing of electrical machinery and equipment increased by a percentage that the production and supply. Wait a minute. It was 17.7%, and that the production and supply of electric power and heat down 12.4%. It would probably help if they put this in a chart. In the first 11 months of revenue from principal activities of industrial enterprises above the designated side was 103.1 trillion yuan, increasing by 4.4% over the year. The cost of principal activities were 88.4 trillion yuan by 4.2%. By the end of November, the total assets of industrial enterprises above the designated side was 105.8 trillion yuan, an increase of 6.7% year over year. The total liabilities reached 59.4 trillion yuan, an increase of 5.6. The total owner's equity was 49.4 trillion yuan, an increase by 8%. The asset liability ratio was 56.1. By the end of November, the total receivable accounts for industrial enterprises above what they call that designated floor was at 12.9 trillion yuan, an increase of 9% year over year. The total value of finished products from industrial enterprises accounted for 3,968.26 billion yuan. That was an increase of 0.5%. The costs for 100 yuan turnover of principal activity stood at 85.76 yuan, and revenue from principal activities bought per 100 yuan assets was 111.7 yuan. Won't go much into this. Profits made by industrial enterprise above designated side. In other words, they have targeting here in their enterprises 774.75 billion yuan in year over year. That was an increase of 14.4. So in other words, it is clearly laid out here where they are in terms, and they do have a chart here, incidentally. I didn't read the chart, but in terms of million yuan, and the charts are much easier. We'll just append this so you'll be able to see it. On to the market people and the Eurozone. So we'll sort of make a little roundup here. Oops. Here we go. This is Eurozone manufacturing PMI. Was the highest since April of 2011. Eurozone manufacturing sector ended 2016 on a high note at 54.9 in December, up from 53.7 in November. The final market Eurozone manufacturing PMI posted its best reading since April 2000. The average of the final quarter, 54, was a solid above the third at 52.1. Above 50 is the reading, as they'd say, neutral reading. Moreover, the average PMI reading over 2016 as a whole was 52.5, the highest average since 2010. National data points to a broad-based improvement in operating condition, with headline PMI readings rising in 7 of the countries covered by the survey. Growth was strong in the Netherlands and Greece. In the Netherlands and Australia, with rates of expansion hitting levels last achieved over 5.5 years ago. PMI indicators hit a 3-year high in Germany and an 11-month high in Spain and a 67-month record in France and Italy. And in 6th position overall, we saw a pace of growth improve, while the rate of contraction in Greece eased to its weakest since the current 4-month sequel of decline. Underlining improvement in performance of Eurozone manufacturing was faster growth of production in new orders. Rate of expansion were either at or close to the steepest since 2011. 6 of the 7 countries covered by the survey saw faster increases in output and new business, except, of course, Greece, with record weaker rates of contraction. Companies report improved levels of new work received from domestic and non-domestic clients, new export business, which that will be affected by a new tariff regime in the U.S. at the second quickest pace since April of 2011. Part of the increase in foreign demand reflected a boost to competitiveness from the euro exchange rate. Faster growth of new export business was seen in France, Italy, Spain, the Netherlands, and Austria. The rate of increase slowed in Germany, while the pace decline eased in Greece, which has had a number of problems for a very, very long time. Strong demand led to pressure on manufacturing capacity, as highlighted by the rate of backlogged work hitting a 68-month record. This in turn resulted in further solid job creation, with staffing levels in almost all the nations are covered. Of course, Greece not being in that line. Price pressures intensified during December. Higher import costs resulting from depreciation of the euro combined with increased global commodity prices, leading to the sharpest inflation of average purchasing costs for over 5.5 years. This also suggests that the supply chain pressures were leading to higher costs. Average vendor lead time lengthened to its greatest extent since 2011. The increase in input costs was passed on in part to clients during December. Output cost inflation accelerated its quickest pace since July of 2011 as selling prices rose across all nations. The survey, the steepest increases were in the Netherlands, Spain, and Germany. And from Dr. Williamson here, he's chief economist there, Eurozone manufacturers are entering 2017 on a strong footing and having ended 2016 with a surge. Policymakers will be double pleased to see the manufacturing sector improve, outlook being accompanied by rising price pressures. To put the PMI data into perspective, the first 5.5 years high reached in December is broadly consistent with factory output growth, an impressive annual rate of approximately 4%. What's especially encouraging in the broad-based return on the nature of the upturn, with the PMI improving in all nations by, of course, Greece. Employment also rose in the closing months up to 16, the fastest rate for 5 years. So this gives us a solid flooring for the Eurozone, at least most of it, considering it's been in the depression for a very, very long time. Much of the upturn in demand and the rise in prices attributed to depreciation of the euro, which companies often cite as making exports more competitively priced, but also linking imports and exaggerating rising global prices for commodities such as oil. So in other words, it's back to sort of a double type of situation. If petrol prices go up, then generally, especially in the U.S. and many of these nations where consumers lead the way, their discretionary income goes down. While the strong end to 2016 is encouraging news, the manufacturing revival clearly remains vulnerable to political risk, particularly in elections in the Netherlands. France, Germany represent potential key flashpoints, which could lead to market intensification of political uncertainty in the region in 2017. One thing to remember here that more and more the political climate of these countries is affecting the economic climate because of the uncertainty. And this uncertainty itself is not productive for business. finish up with Doctor, with the expectation that the Eurozone economy growth will slow slightly in 2017, down from the 1.7 in 2016 to 1.4. Now that in itself is a very interesting prediction. That means that part of the world economic pie will in itself slow, and what effects that will have on the global economy, one would look we're now moving to the BBC here. And we're just seeing if there's anything. Gold powers a new high on the FTSE 100. Well, okay. And not a lot of other news today here. We covered a lot of it. We're going to do a special report with the political side, Boston Red, on robotics. And the future of work on the robotics takes a little bit longer to do something of that nature as opposed to some other types of production. I see one here we'll take a quick look-see at. 0-hour workers face £1,000 pay penalty. Now, I'm not certain what people on the contracts face a precarious pay penalty of 6.6%, or 93 pence an hour. The think tank estimates. Now, these are workers typically earn $1,000 less than permanent employees. That's according to the Resolution Foundation research. For those who earn the less, the size of the gap is the greatest at 5.5%. The foundation-backed government decision announced last month to hold a review into modern work practices. Understanding the reason behind the pay penalty will be critical in order to tackle some of the challenges raised by new forms of employment without jeopardizing the success of UK's flexible market. 0-hour contracts have hit the headlines in recent months for their widespread use in Sports Direct and JD Sports, but concerns about the use and abuse of 0-hour contracts go wider than a few notorious firms. The evidence is their use in association with holding down wages. A new way of working continues to grow from 0-hour contracts and agencies working to the gig economy. In the U.S., the gig economy is basically things like Uber, who is going as quickly as they can get to it, to self-driving cars. We need a better understanding of how they work and hinder people's earnings and career possibilities. Policymakers must also tread a careful path between getting to grips with the living standards and challenges thrown up to new and other insecure form of employment. And that is one of the problems we have in the U.S. A large number of quote-unquote temporary jobs are being created. Temporary jobs used to be literally the stepping stone to a better job, and now it becomes more of a permanent way of the work cycle. From Matthew Taylor, he's Chief Executive of Royal Society for the Arts, has been appointed to lead a government review as to how the so-called gig economy is affecting workers' rights, no doubt. And this is an important situation that is not only in the UK, but it's in many other places besides the UK. So it's very critical that we came upon this as The 0-hour contract worker faces a precarious pay penalty of £1,000 a year. Workers on zero contracts face that for a typical worker compared to similar workers doing similar jobs. This is contract workers. The analysis was the first to pinpoint a specific precarious pay penalty associated with so-called 0 hours. The number of workers on these contracts recently reached 900,000. We find more specifics here. To get to the real pay penalty associated with 0 hours, a foundation and analysis compared the pay of 0 hours to non-zero hours workers with similar characteristics doing similar jobs by controlling the wide range of factors, including workers, gender, age, etc. These factors explain 4/5 of the overall pay gap between 0 hour and other workers. The analysis highlights remaining precarious pay penalties of 6.6% per hour. The analysis also found that the precarious pay penalty is greater still for 0-hour workers in lower pay roles, with the lowest 20% earning experiencing a penalty of 9.5%. So this is a little bit different from what we normally see. We'll get back to this and put it in our part-time workers as for the holidays, whether it be. So these would be Friday, unless otherwise noted. The FTSE All-Share was at 12.17. And on Sunday, the BBC Global 30 was at 0.27. In Amsterdam, they were at 2.43. The DAC was at 98.92 on Monday. So we're getting Monday readings here out of Amsterdam. That was also on Monday. In France on Monday, also 23.16. In Brussels, they were 17.98. In Madrid, 47.50. In Zurich on Friday, they were down 31.26 to end the year. And in Moscow today, they're 23.35. In Johannesburg, on Friday, they were down to 94.82. In Bombay today, they are down 31.01. In Karachi on Friday at 144.31. In Lahore on Friday, they were down 45.11. In Colombo, on the all shares on Friday, they were down 17.45. In Tehran on Sunday, they were down 590.60. In Sydney on Thursday, they were down 27.60. The Nikkei on Friday, it closed also for the New Year's holiday, 30.77. In Hong Kong, the Hang Seng on Friday at 209.65. In Shanghai on Friday, 7.54. In New York on Friday, they were down 57.18. And the NASDAQ was down 48.97 to end the year on a down note. The Merck on Sunday, wait a minute here. No, we don't have anything there. With Merck anyway, we'll go on. Well, wait a minute here. They were down a negative 10.43. In Sao Paulo today, they are down 1046.17. And in Mexico on Friday, they were down 266.41. Look at the commodities. We had a very long discussion on commodities and Smithfield and the pork bellies, so to speak. Brent crude today was down 3 cents at $56.82. The spot was up 51 cents at $56.71. West Texas crude was down 5 cents at $53.72. T-Boone Pickens is jumping for joy. He remembers $15 a barrel oil. Cocoa futures were down $39. This is on the ICE futures, the U.S. market. Gold was up $12.30 at $1,159.10. That's on the Forex. On the Dubai futures, an ounce was down $3.90 at $1,052.60. Silver was up 18 cents at $16.24 for those that are interested. The Euronext light futures, we usually go to this. Cocoa was up $13. Robusta coffee was down $2. White sugar futures were down $2.07. Winter feed wheat was up 10 cents. And corn futures were up $1. The Bloomberg Commodity Index was down 15 cents at 87.51. This will do it for us. And incidentally, the BBC News is provided by digitaloutlook.com. We usually use the BBC to get the market data. We understand there are many, many other ways of doing it. So this sums up our first edition of 2017 on all of our channels under the brand of Numbers Man. We will return weekly and have some special programming this year. We had some in 2016. We intend to have more, and we'll start to return to our video portion, the audio portion in a video portion also, and that's one of the things that we will be doing more of. We used to simulcast our episodes on a live stream. A live stream was a bit expensive, but we'll be doing more of this on YouTube where we have the audio now, and we'll go to the visual. That is especially productive in terms of charts, that we can literally look at the charts and that you can actually see what is going on there. Here we have to try to recreate it through the magic, quote-unquote, of radio. Have a good week, everyone, and hopefully a good holiday. Happy New Year and happy holidays. Make it a productive week if you're in the business, and we'll get the final holiday numbers, the New Year's Eve sales, the after New Year's Eve sales, the before New Year's sales, etc., and see how the retailers fared, as one would say, and recap the holiday sales also. We obviously will have those final numbers in. And for the consumer, obviously, you've been keeping your eye on the ball. The economy in both Europe and the U.S., considering the aftermath from the Depression, is basically on a sound foundation. But there are a lot of, as they say, soft places out there. And the problem in macroeconomics is if you make one mistake, or if you deregulate where you should be regulating, that can, as what happened with the swaps, mortgage swaps and other things, cause enormous erratic behavior within the markets and within the whole economy, particularly in the financial sector. As we noted in the last broadcast, the banking enterprise stocks are up, but it does not necessarily mean that the banks themselves, if you stress test them, are any more solid than before they were up. They're in anticipation of deregulation, which deregulation in itself is bad for the banking community as a whole. We don't want to create a bunch of situations like we saw with some of the banks, particularly with Wells, and those huge fines where they were literally selling consumers items they call it upselling, but the consumer never requested. that type of willy-nilly capitalism is not, we call it conveyantor, is not welcome in a 2017 economy. And for those that yelled out here, well, we need to have some risk. The problem is with risk, there are two sides to it. There is one side that is betting on an item, and the other side, we call it shorting, that's also equally betting that things will fail. So the short sellers are always busy, and they will be busy in 2017. Good day.